It's a countdown to chaos. I'm your host, Steve Van Metre, and thanks for joining me today. And our lead story of the world isn't ready as the unfathomable looms. And this is something that not even consumers, corporations, investors, nor even the political elites are prepared for. And as you're about to see, it's going to be here in the next 90 days. Plus, we have a sponsor for today's show. Caliber Mining is back. You can find them on the OTCQX under the symbol CXBMF and on the TSX under the symbol CXB. They just had some recently announced drill results we'll talk about, plus an incredible chart setup. And as you know, many of the stocks we feature on the show go vertical the following day, and we're going to show you a setup for a 35% move to the upside as buyers have put major support under the stock. Stay tuned to the end of the show or check out the pinned comment or description for more information. Now, let's go to Bloomberg, where we picked today's story up with the headline, U.S. small business optimism drops by the most since the end of 2022. This is now the biggest drop in 3 years. And as we look ahead over the next 90 days, we see something very interesting, that investors are primed for massive corporate profits and a big jump in earnings. Consumers looking like they're hoping to get ahead of inflation, and political elites ready to celebrate victory. But what is about to happen is the exact opposite. And here we can see that U.S. small business optimism suffered the biggest drop in more than a year due to deteriorating profits and diminishing sales expectations. This according to the National Federation of Independent Businesses. And this is a big deal because small businesses are usually one of the first beneficiaries of kind of an increase in economic activity. And here we can see that diminishing sales and expectations are weighing on their confidence. And this is a major problem because they have been looking to hire people in a big way. They've been expecting a big jump in demand, and now they're seeing the exact opposite. And yet this comes at a time we've been hearing from the political elites that the no landing scenario is now the base case. Well, the no landing is about to turn into a hard landing in the next 90 days as the group's overall index fell 2 points to 89.9, the sharpest monthly slide since December of 2022. The share of owners who expect higher real sales volumes slumped 12 percentage points, the biggest drop since mid-2022 from a month earlier. So all of a sudden, as everyone is geared up for more sales, they've gone out, they've driven the new order books, they've started building up their inventories. What did they find out? That just because you have it and you've raised prices does not mean people can afford it, and suddenly consumers are voting with their wallets in a big way. As small business owners continue to make appropriate business adjustments in response to the ongoing economic challenges they're facing, this is something we don't want to see happen. Because one thing I've noted, that when small business owners realize that sales aren't coming, they have one thing they have to do to stay solvent, and it is indeed unfathomable. As a more positive view of the future economy and economic policy would help stimulate longer-term investment spending, but currently, owners' views about the future are not supportive and financing costs are very high. So again, as we hear from the political elites that the no-landing scenario now is the base case, that this is indeed the beginning of the next big economic expansion, small business owners are not seeing it. And when they lack the confidence in the economy, well, one thing they don't do is go out and borrow a bunch of money and expand their businesses and get prepared to take advantage of this big economic boom. So the fact that they don't believe it, well, it's a red flag in the economy in the big way, suggesting what is coming over the next 90 days is going to be devastating. As the share of owners planning to boost employment dropped to the lowest level since May of 2020 is 39%. The small share in 3 years had job openings that they were unable to fill, with an overwhelming majority continuing to cite a lack of qualified candidates. But here's the big red flag. We think about, as employers are not seeing demand, the first thing they're going to start to do is trim employees. And this is a big problem because we've been hearing over and over how robust and strong the U.S. labor market is and how it's going to drive inflation above trend, keep the Fed in play longer, and going to continue the beginning of what this is now of an economic expansion. Small business owners are not seeing it. They're going to be forced to put people on the unemployment line at a time they really don't want to. They want to believe everything's changing, that the economic policies of this country are working, and they're not. But meanwhile, 15% of the owners reported reducing selling prices, representing the largest share since August 2020. This is indeed the unfathomable as we look at what is coming, is outright disinflation now turning into deflation. We're seeing business owners cut prices. This is a problem. That means they're seeing exactly what we predicted on the show, that higher prices are not being met with an increase in demand. In fact, it's even worse than that. They're seeing demand outright start to crash, forcing them to lower their prices just to get people to buy. This is a big risk and only going to get worse over the next 90 days. And while inflation is cooling and becoming slightly less of a concern among firms, a significant portion of owners are still identified as the single most important concern in managing their business, because the issue here is they can't continue to raise their prices. They're so desperate to. They need to. In fact, they had a glimmer of hope a matter of months ago, and we can see this here in this chart against the inflation adjusted or real retail sales. This is where we take the retail sales data and subtract off the consumer price index, because what we can know is that periods where retail sales fall below inflation, well, it tells us we're generally in a recession, and we can see that we have been in one, even though, of course, nobody wanted to make the official call. We're finally starting to see some signs of the data pulling up here, suggesting that maybe things for retailers are going to get better. But there's a big shock that just happened last month that's telling us exactly where this economy is headed. There's a reason why confidence among business owners is falling, why they're having to cut prices, and soon they're going to have to start cutting employees. And we can see that in this chart here, where we continue the theme of real advanced retail sales data. Again, inflation adjusted against total compensation, showing average hourly earnings multiplied by average weekly hours of production and non-supervisory employees. And what business owners need to see, particularly small business owners, they need to see people making more money so they can afford the higher prices. But we look in the past here, and we can see when total compensation growth is slowing, what happens to retail sales? Well, it goes down. And we see that going into the dot-com bubble. Of course, we see that during the global financial crisis. We see that following that, as we almost had a double-dip recession coming out of the global financial crisis. And what did that do? It pulled retail sales growth down. We saw it again as we were headed into a globally synchronized recession around 2015, 2016. And look at now, you see this hope that was growing, that adjusted retail sales were moving higher. But what has changed here is that was all a debt-fueled binge. And that's what we're seeing from the small business space. They're looking and saying, wait a minute, our customers can't afford higher prices. Well, it could be that total compensation fell off a cliff last month, and now it's forcing them to lower their prices. It's going to force them to cut their staff unless there's a big turnaround in the data. And of course, this lack of income to many American households is going to show up in the data over the next couple months. But one company that's running a big red flag telling us where other corporations are going, that was none other than Hasbro today, as they reported a 20% revenue drop and issues a downbeat 2024. Now, if we were seeing a big turnaround in the U.S. economy and the global economy, well, certainly Hasbro would benefit from this, because they're on the discretionary side of people spending, and instead, their outlook is rather bleak. And for the last 3 months of 2023, Hasbro lost over $1 billion. And after major adjustments related to goodwill and intangible assets, their earnings per share was 38 cents, was still well below estimates. And for the full year of last year, revenue declined 15%, including double-digit sales drops in its consumer products and entertainment segments. The company then followed up by reducing its inventory by more than 50% compared to a year prior. This is something, again, as we look at investors who are just primed to see stocks roar higher here, Hasbro is warning, look, we're on the discretionary side of the economy. Things did not go well for us over the holiday season, and even worse, they're not looking good for the coming year. And it makes perfect sense then of how we see this unfathomable scenario play out over the next 90 days, is because total compensation fell off a cliff. This hasn't shown up in a lot of the other data yet. That's the key. When people get paid, if we don't see a follow-up in over the next 90 days then into other economic data series, the problem here is what it means is with a lack of spending, it usually leads to an increase in unemployment. Here we can see the relationship between total compensation in red and continued claims in blue. As total compensation growth slows, people spend less. As they spend less, well, employers have no choice but to send people to the unemployment line. You see that again here in the dot-com bubble, the global financial crisis, and you see it brewing now. There's this huge drop in hours worked last month, sent total compensation growth slowing. That means less money will feed through the economy and ultimately impact the labor market. And we're going to see that again happen over the next 90 days. This is something virtually nobody is prepared for. But one thing that's interesting is how we're seeing this impact consumer prices today. Well, wait, it's going to get worse in the whole near future. As U.S. inflation tops forecasts and below the Fed rate cut hopes. And you talk about the lag of the data, and this is absolutely brilliant because we see here inflation came in hotter than expected. The market violently react, and we saw stocks go down, bonds go down. Everybody said, oh no, the Fed now is in play longer. The Fed, of course, is going to take this as a vote of confidence, saying, look, we told you. We've been warning you, we're going to have to keep interest rates elevated longer. The market has been wrong on this prediction. The issue here is what we're seeing over the next 90 days is going to have a big change in, of course, the CPI as well. As the so-called core consumer price index, which excludes food and energy, increased an impressive 0.4% from December, far more than expected, and the most in 8 months. From a year ago, it held steady at 3.9% year over year. Meanwhile, economists favor the core gauge as a better indicator of underlying inflation than the overall CPI. That measure advanced 0.3% from December and slid to 3.1% from a year ago. And sure enough, the BLS's annual revisions confirmed inflation receded as fast as initially reported at the end of 2023. But the new weightings, which are effective as of right now, as of this report, will place a greater emphasis on services and less on goods, which economists will say slightly boost the outlook for the CPI this year. So this is very interesting. We see changes by the Bureau of Labor Statistics is now artificially keeping inflation a little higher than it normally would, which is exactly what the Fed wants, because we know for a fact they are not data dependent at all. The Fed wants to keep interest rates up. They're worried about a rebound in inflation. We're going to make the case that is unlikely, and it's going to show up in the data in a big way in just a matter of 90 days from now. As excluding housing and energy, services prices climbed an impressive 0.8% from December, the most since April of 2022. That's what's called the super core. And while policymakers have stressed the importance of looking at such a metric when assessing the nation's inflation trajectory, they compute it based on a completely separate index. But we can tell you it doesn't matter what they calculate, what they do. What matters in a debt-based economy is the money people have. And if they don't have it, the money they can borrow. We know that, of course, lending standards are tight due to the inverted yield curves and money curves. We know consumers borrowed big time through the end of the year. It didn't translate into anything big for Hasbro, but they also tapped out those buy now, pay later. All of those bills due and been coming due. They're going to have to make the payments. And what happened? Total compensation cratered. Of course, that means inflation with a lag, as you can see here. This is what we're calling for over the next 90 days. The unfathomable, which is inflation, drops out of the floor. And next thing you know, policymakers are panicking, as too are investors and consumers. Here, as we see the CPI in blue against total compensation growth in red. And you can see where compensation goes. Well, no surprise, inflation falls, and this little uptick has got everybody excited, well, except those who have to go to the store. And we know policymakers are just out of tune. As we look at the new data series here, this from the Bureau of Labor Statistics, where do we see food prices up? And this is obvious. Anybody who's gone out to dinner or gone to the grocery store lately has noticed we've seen a little resurgence in food prices. This is an issue here. How about the energy sector also driving the report? But the big one, services sector. Remember, they revamped this to focus the data series on services. Here we can see shelter up 0.6%. Transportation, this is why we're at the airport, because I don't think there's going to be a lot of people here a whole lot longer. That up 1%. Medical care up 0.7%. What we're going to see here, though, is over the next 90 days, this big drop in total compensation is going to backfeed into the consumer price index and likely put us right at or even below the target trajectory of 2% and continuing to spiral down from there. And Fed officials will have access to multiple inflation reports, including one more CPI print, before their next meeting between March 19th and 20th. Of course, Wall Street has been pushing for the central bank to ease, and we know that they are always behind the curve, but now likely, based on this data, to stay on hold for the fifth straight meeting. And that's part due to the strength of the jobs market. A separate report on Tuesday showed real or inflation-adjusted earnings advanced by the most since July on an annual basis, extending a month-long streak in which wage growth has modestly outpaced inflation. Of course, we know that that's a little bit of a lag data here because hours worked got crushed, and that's what these policymakers can't see. Just because hourly earnings go up does not mean people's paychecks go up. This is a big problem. This will backfeed all the way through the data over the next 90 days. The labor market doesn't stand a chance here. And sure enough, we see consumers start to echo this as three-year inflation expectations now tumble to the lowest on record as earnings expectations suddenly surge. And this makes absolutely no sense at all. So here we can see that people are spending less money. We see that stress going back to the small business report. We see inflation slowly continue to cool down, and yet investors piling into U.S. equities. And remember, at the beginning of the show, I said they couldn't see what's coming either. They expect massive earnings coming, and the unlikely is going to actually happen, because if companies can't push pricing increases through, as small businesses are saying, look, we can't do it, we're starting to cut prices, well, that's going to have a big shock to the market investors as well. And 1 month after inflation expectations tracked by the New York Fed Consumer Survey extended the recent slide, when December 1 year inflation expectations saw the third consecutive decline for a series, which traditionally is also a proxy for the price of oil, and which last month dropped the lowest since January 2021. Moments ago, New York Fed reported results from their January 2024 survey, which found that while 1 and 5 year inflation expectations were unchanged, the 3-year slumped to 2.4%, now the lowest on record. And if you're talking about corporate profits, this chart tells you everything, because if we look at the consumer price index shown in blue against corporate profits, well, you can see the downward trends, disinflationary trends in consumer prices. Well, that puts a flat line at best on corporate profits. Here you can see during the global financial crisis, consumer price index came crashing down. Well, corporations, if they don't have the pricing power, well, that means demand goes down and their margins go down with it. You see it here going to 2014 through 2016, even heading into pandemic. Now, consumers are championing a decline in inflation, saying that, hey, corporate profits are going to skyrocket. The reality is the opposite of that is going to happen, and we're going to see it play out over the next 90 days as we get into the next earnings season. There's going to be a little renaissance period here where people buy into it until they find out the truth. And Hasbro is just giving us that early warning. Here's some more details. Median inflation expectations remain unchanged at the 1 and 5 year ahead horizons in January at 3% and 2.5% respectively. But over the 3 year, again, they decline. Here's the big picture as we look at 3 year expected inflation against the consumer price index shown in blue. And what we can see is a downward trend in expectations means a further downward trend in the headline CPI, putting us on path not only to get to the Fed's target, but to break through it. And over the next 90 days, as all this comes through, it's going to be a massive shock. Again, to consumers, we're going to find out the labor market is going to go to political elites, that indeed that no landing scenario is turning into a hard landing, and investors and companies as they find out that hopes for big profits are dashed. But one company we do believe is going to be driving some major profits in the future and has got a lot of upside potential. That's our sponsor for today's show, Caliber Mining. Again, you can find them on the OTCQX under the symbol CXBMF. XBMF, and on the TXX under the symbol CXB. Let's take a look at what's going on with this company. They've been on the show before, and they just announced positive drill results on 1 kilometer southwest of Valentine Gold Mine resources, demonstrating a strong discovery potential across the 32-kilometer shear zone, Newfoundland and Labrador, Canada. This is big news. As we know, we look at their stock, and we're going to look at that here in a bit and see how the market is reacting to this. Over time here, they believe that Caliber's price is undervalued by as much as 35%. We're going to show you this chart setup. It's quite incredible, but let's take a little deeper look here as the company provided results from the recent drill program at the Frank zone, a high priority gold target 1 kilometer southwest of reported mineral resources on the Valentine Gold Mine property. This is big news because Frank is one of the many additional opportunities, along with highlighting the strong potential for discovery and expansion of mineral resources. Caliber is also pleased to provide the 2024 exploration program for Valentine. You can find all this information on their website. We've got links in the description below. Again, on the OTCQX under the symbol CXBMF, and on the TSX under the symbol CXB. Now remember, as we noted, several of our companies we've recently featured on the show after the day after the promotion, their stock has gone nothing but up. This is one you don't want to miss out on either, because look at this. This was a quad bottom forming. This is quite incredible. And there you can see every time it's gotten down here, what's key is volume has come in and supported these bottoms. And that means big buyers stepping in at this price level. You can see it validated by the volume profile line here. But what's notable is the triple top is not matched by as much volume at all, suggesting that the sellers here are getting weaker and weaker over time. And notably, we're looking at a reversal here. I'm going to show you on a chart as we zoom in now that this here, a move up to the upper supply zone, a breakout of where these sellers are at. This is going to be a massive catalyst once they're burned out to take the stock 35% higher. And here is all the evidence, because the buyers are coming in at higher and higher levels supporting the stock. Here you can see the volume profile at $1.02. This as of the last 30 days. You see price today, because the market's down, came into the supply zone and picked up buyers. We see on the short-term phase that momentum is now reached oversold territory, looking to put in a major reversal here, and has the potential to send Caliber Mining up by 35%. But as always, with any company you feature on our show, you're under no obligation to purchase their stock. Be sure to do your own research before placing any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.